And welcome to the TSP Weekly Podcast, the only place you can come every week to talk about the thrift savings plan. If there is another place, let us know, guys. I don't know. I haven't found one. Not on a weekly basis.
I don't know of another podcast that does it. That's for sure.
No. Every once in a while, somebody will pop up on YouTube that does a few videos, and then they just disappear. And we've been doing this, I don't even know, honestly, at this point. It's 4 years?
4 or 5 years, yeah.
Something like that. But yeah, we take our Friday afternoons off just for you guys.
And what a Friday it strangely hasn't turned out to be. Like, we had GDP came out today. It's 1.4% for the fourth quarter of 25. And it was expected to be 2.5%. And even that was down because it was over 4% for the third quarter of 25. And then we got, a potential Iran thing ramping up over, this coming weekend. And there was one more. I can't remember what it is. But there's been a lot of stuff in the market scene is just shrugging it off.
Well, we talked about this months ago, I think. I mean, we got in the habit of saying like, oh my gosh, it's been a crazy week. And here it goes, and that just kind of like became cliche because every freaking week is crazy. There's always something happening in either the economic world or in the, public policy world in some way that is, that's impacting the market. So I honestly think that the market itself has just become numb. They're just like, oh, war with Iran? No big deal.
You're not even seeing a big spike in oil. I mean,
nothing. Well, yeah. I mean, we could talk an hour about that. I mean, I put my public policy hat back on from back in the day. I mean, that was my master's degree was in public policy. I used to like that stuff. Now it just irritates me. Because I don't want to hear about it. But it's just the things that it's all based on what we're being told. So we have to take all that for a grain of salt. And what's really happening in the background is usually a little different than what's happening. But the idea of going to war with Iran is like not a good thing. I don't really want to have it. I mean, I don't have, well, you still got 2 in the military.
Yeah, I got one that just deployed last week.
Yeah.
She's underwater, so that's a plus.
It's still scary when stuff's going on and your kids are out there. I mean, even when I was still in the reserves and stuff and deploying and yeah, it's just, these are people, there's real people doing real things out there. And it's scary. Whether we actually go to war, people have died in, non-combat situations because you're prepping for combat. So anyway, if any folks out there have any loved ones involved in this, we're thinking of them.
Yep.
But hopefully we don't like hope as a plan. Hopefully, though, this all just passes and it's a lot of saber rattling and so far, no massive impact to the market.
Nope. So far, we shall see. Okay. So this week we'll take a look at economic highlights. And then we always, at the end of all the podcasts, we always say, hey, if you guys have questions, send them in to us. And we got a really good question sent in sometime this week. It was about the 4% withdrawal rule in retirement and inflation and how all that works. So we'll talk about that. A couple slides on what the current market structure is. And I got a pretty good, basically midterm election years, pretty valuable to look at once midterm elections happen, what happens with the market, and then the TSP fund direction. So 30-year mortgage rates continue to fall. They've been falling since peaking here in 2023, right? We got consistent lower highs all the way down, and now we're down here at about 6.2%, right? So that's really good. The lower we get, obviously, the better if you're looking to buy a first home or something like that. If you really want to kind of drill down on it, this is the chart of, and it's the Elliott wave theory of the 30-year mortgage rate, okay? So this was the bottom in rates at the beginning of 2021. And it's mortgage rates, right? It's not the 10-year yield. It's actual mortgage rate, 30-year mortgage rate. So we were down here at about 2.5%. And if you bought a house, got a mortgage down here at 2.75% to 3%, you're probably as low as anybody's ever going to go. But we had a 1 wave up, a 2 wave down, a long 3, a 4, and a 5 that took us to almost 8%, right? That was at the beginning, end of 23, beginning of 24. So that's a 1. And if you recall, if we started back here, from 1980s, early 80s, mortgage rates were, I don't know, the 10-year yield was up close to 20%. So mortgage rates were really high, but they had been declining for 40 years down to 2020. And so this is the first big tick up in a 40-year decline cycle. So in the big scheme of things, the question is, if this is a 1 and this is a 2, do mortgage rates start going up on a 40-year incline, right? Because we just came off of this 40-year decline. Are we beginning a 40-year incline? Hopefully not, but that's something if you're looking in the long term, it's something definitely to be kind of.
So how far would that need to go up though to hold true to the to the Elliott wave principles? That line you drew going up, how far did it have to go if it was to?
The 3 wave, it can be as long as it goes, but it's generally 1.618 times the length of the 1 wave. So if it went from let's say 3 to 8, that's 5 points, came down to say 6. I mean, you're talking about 18 or 20%. It's a lot over, and it would take a long time to get there. And maybe your income would come up enough to make that viable. I mean, all kinds of things would happen in there.
I was just trying to. I thought there was like a rule as to what that length would be, and then I would give people a perspective of like it's not infinite. It wouldn't go up to just like it could. I mean, it could do anything. We're not saying we're calling the mortgage rate a market, but if it follows the rules you were showing right there, the expectation would be that it would go to, and I can't read the numbers on the screen, but
yeah, it can go much higher. There are a lot of people that are calling for much higher rates, much higher inflation, much higher interest rates. I mean, all this stuff will happen in cycles over, years and decades, but there aren't too many people that think we're going to be anywhere down here like ever again.
Yeah, I don't know if that's sustainable or even, I don't think we need that, right? I mean, again, I've brought this up on the podcast before. I remember I bought my first house in 1993 as a young soldier in the Army, and I paid $75,000 for it, and I had an 11% interest rate or somewhere in that neighborhood. I don't remember. It might have been 9%, but it was huge compared to now. And it is what it is. You get the market you have when you need to buy a home, right? And it was sustainable. It was also affordable. That's the double-edged sword here. That's the two pieces that you have to always put in. What is the cost of housing now, and what is the cost to buy it?
Right.
That's the part that's actually killing us right now. Is I bought a 3-bedroom house with a pool in the backyard for $75,000 in 1993. That's not doable. I mean, even in today's prices, that's not doable.
Yeah. The thing that's interesting is, back here from the 80s, as rates came down, and they came down like this, but as they came down, prices went up because it's basically an affordability question, right? If as what you have to pay to borrow goes down, what you can afford to pay in price goes up to keep your monthly mortgage payment the same. So the idea should have been, when we got down here and rates were really low, that should have been a high in price. But all through here, rates skyrocketed on a percentage basis, right? We're down here at 2.75%, 3%. We went we more than doubled. But price also went up, which is what is screwing everybody. And so as rates come down, right, this is when the price of housing should be going up. The whole cycle is backwards now. It's all messed up.
Yeah, that's definitely the part to really point out, I think, for folks that are looking at this. Always look at both numbers. Are housing prices increasing, right? The cost of housing, and then the cost to borrow the money to buy the house. If both those are increasing, we're in a horrible position. And I don't know enough about, building homes to know exactly why, other than that just materials are costing more and labor's costing more, right? But I mean, particularly, we do live in a very unique area in Northern Virginia, but it's just getting astronomical to live
Yep.
here. And then when you pack on top of that a 7%, interest rate to borrow, it's 6%. Either way, like that's rough.
Yeah, it's brutal. um, yeah, I don't know. I don't know what happens even if rates really come down. Like the reason I put up this chart was, and I've had this for a while. I had to adjust this a little bit because I thought this ABC was going to be the 2, right? And then rates would start going up. But that's not what's happening. So you look at the pattern and see how it evolves. And now, as it is right now, it looks like we're doing what's called a flat. So you got an ABC for an A. So this is your A wave down. So the 3 moves, ABC or 1, 2, 3, however you want to look at it, is always corrective. And so you have your first corrective move down. And you get outside of that move, that's how you know you're in the next move. So we have an ABC for a B, and this ought to be a 1, 2, 3, 4, 5 to get to the C. That'll be the 2, and then rates should start going back up. So however this pattern does end up playing out, whenever we get down here, and this was the A prior high from 2018 or 2019, and we had a retest of it here. So it wouldn't be surprising to see rates get down to 5%, and that be the floor, and then we start moving higher again. Doesn't mean it's going to happen that way, but that would be pretty consistent with the flat, right? ABC for an A, ABC for a B, 1, 2, 3, 4, 5. We get down somewhere near 5%, and then rates start going back up. It could work out that way, but right now it looks like a flat consolidation pattern, and once it bottoms, rates go up. The next direction for rates is up in the long run. Not in the short run. Short run they keep coming down. In the long run, the next direction is up.
And that's going to be your last best time for a while to get a mortgage.
Yep. If something happened that rates got below the top of the 1, then this whole 1, 2, 3, 4, 5 is wrong. So that's it's a pretty big range, but it's the beauty of Elliott waves. You know when you're wrong.
Right. But the economic conditions that would have to happen to get it down that low are pretty extreme.
Oh yeah. I mean, if the Fed dropped rates to 0, it's because the market's absolutely collapsing.
Yeah.
All right. So that's what that would look like. Initial jobless claims fell by 23,000 from last week to 206,000, well below market expectations of 225,000. So that's amazingly good. Initial jobless claims, right? These are people that are first time applying for unemployment. So again, in the numbers, there's a lot of talk in the media about layoffs, but in the numbers, we're not seeing a lot of people making initial jobless claims. And we had the last couple of months were relatively high, over the past, say, 6 months to a year, but they're pretty much average going across. If we can stay down here and don't have a lot of people filing initial claims, the unemployment rate stays low, and it keeps the odds of a recession down. It's also makes it harder for the Fed to cut rates, right? So how does it affect the market? If it's hard for the Fed to cut rates because unemployment is not going up, then the market does not like that. PCE came out. Personal consumption expenditures is one of the key inflation reports that the Fed looks at. Rose to 0.4%. So it rose 0.4% last month on a month-over-month basis, and it's quite a bit higher than the 0.3% rise. And this is kind of what it looks like. So we were talking about how inflation has not been going up, even though everybody's talking about how tariffs are causing inflation and everything else. This month we got a big jump in the number. So up 0.4%. and it's the PCE. So it's what we feel. It's not, services or manufacturing inflation. It's what we're feeling. And so prices of things are definitely going up. But again, not inconsistent with previous, averages. So hopefully we don't get up here, because then we're looking back at what we were doing in 21 and 22 with inflation going higher like every month. And then we get this out on Friday. Fourth quarter U.S. GDP up just 1.4%, badly missing the estimate, and inflation stays at 3%. So GDP was up 1.4%. It was over 4% in the third quarter of last year. The expectation was for a 2.5% gain for the fourth quarter. We didn't get that. And the market kind of shrugged it off. Not a whole lot is happening, at least as of Friday morning. They put a lot of it on the government shutdown. They think that caused about 1 percentage point off of GDP. And at the same time, inflation held at about 3%. So the economy is weakening. Inflation is not coming down to the Fed's 2% rate. But also unemployment is not going up. So we're in this sort of stagflationary kind of environment, and it's sort of being reflected by the market going sideways since October. Okay. So really good question. We got a lot to talk about on this one. So the 4% rule and inflation. So the question came in, I would like to have the topic, how to maintain your TSP account in retirement so it stays ahead of inflation beyond just the 4% rule. So I got a pretty good article from Seeking Alpha. The 4% rule was built for owners, not renters. Traditional retirement strategies and plans were built for a world that no longer exists. The 4% rule and other rules similar to it were made under the assumption that mortgages were paid off and major assets were owned outright. So back in the day, the idea was you would go into retirement and your house would be paid off, your cars would be paid off, and you're looking at using this 4% rule as spendable income, right? So you're not using it to make mortgage payments. Expenses were predictable, occasional surprises, inflation is modest, market volatility didn't directly dictate monthly spending decisions. All that is different now, right? Inflation's going up and down, the market's going up and down, and if you have to use that 4% income, if it has to fluctuate a lot, you can't just take your 4% and call it a day. I'm retiring. I'm going to do 4% of my my balance, and I'm going to do that, for the rest of my life. Things are just different now. Households are increasingly indebted. Gen X, which is us, entering their 50s and 60s with the highest average debt of any generation. Right? It's very tough. It's not a lifestyle critique, right? It's a cash flow reality. So most of us aren't going into retirement owning our homes outright. And for a lot of reasons, a lot of it is because people, the narrative is that you shouldn't, and it's reasonable, you shouldn't own your house outright because generally you're paying a much less of a rate for your house than you are for any other debt. So carrying a mortgage isn't necessarily a bad thing, and there are tax breaks for carrying a mortgage. So, but life is different now than it was back when this rule was created. So it was created here by actually coined, I guess, by William Benjamin in 1994. So 1994 doesn't seem like it was all that long ago, but things were financially much different, right? So it's 4% is a retirement planning guideline that suggests retirees can safely withdraw 4% of their portfolio in the first year and then adjust subsequent annual withdrawals for inflation, and likely that money will last you for 30 years. Okay, so that's the basic idea. It's developed in 1994, assumes a 50% stock bond mix. Okay. So it's a standard benchmark. It's criticized for lacking flexibility, ignoring taxes and fees, which is an important one, and not accounting for longer lifespans, right? Because you definitely don't want to run out of money. So let's kind of work through like a problem, right? let's say you've hit the goal that every TSP person has, and you're in the $1 million TSP club, right? If you're doing the 4% rule, you get to spend $40,000 a year. You have $1 million in the bank in TSP, and if you're going to use the 4% rule, you get to spend $40,000 a year. It doesn't sound like a lot. It may be. It depends on your circumstances, right? It may be plenty. When you add it to your pension and your Social Security, that $40,000 might put you into a place that you can comfortably have the standard of living that you want, and you're good. You go into retirement. If 40,000 doesn't do it for you, at this point you're kind of stuck because you have your million, right? If you had 2 million, you'd be able to take 80,000, and that would be better. But if you have $1 million, you got your 40,000 a year. If you put it under your pillow and subtracted 40,000 a year, it would go to zero in 25 years. If you put it under your pillow, you wouldn't be getting any market return, but you also wouldn't have any risk, right? The current G fund rate is 4.25%. So if your TSP is in the G fund and you're using the 4% rule, then your million is going to increase. You're gonna make more gains in the G fund than you're taking out every year, assuming that G fund rate stays at 4.25%. So that's the first part of it, right? How much you have in retirement. The assumption is you're using the 4% rule, and the assumption is that the G fund rate stays at 4.25%. The first big variable is inflation. So right now, inflation is about 3%. So you have to add inflation to the amount that you're withdrawing, which is 4%, right? So to keep your million in the bank without decreasing the principal, you need to make 7%. So over 20 years, the average rate of return for the C fund is somewhere between 8 and 12%. So let's call it 10%, right? That's between 8 and 12. The G fund average since inception is 4.7%. So if we're using the average C fund and the average G fund, and we're using the 50-50, stock bond, that gets you 7.35%. So on average, you take all of this together at 7.35% with the 3% inflation, using the 4% rule, your $1 million will stay, will grow a little bit, but basically stay $1 million, and you can take out 40,000 a year. All the numbers are great, right? The problem is that there's always market volatility. So at the end of the day, we were talking about this earlier, as long as you don't dip into the principal, one of the best ways you could probably do it is take the last year, 2, 3, figure out how much you gained on your million. Let's say 1 year, it was up 2%. The next year it's up 6%. So there's 8. And then the third year it was flat at 0. So you take that 8%, divide by 3, it's 2.5% or whatever. That year, maybe you're only taking out 25,000. Because if you dip into the principal of that million, that's when you start to have problems. That's when your million is at risk. And the market, if you're looking out at a 25 or 30 year retirement, the odds of a 50% decline or drawdown in the market is pretty high. So if your principal draws down from $1 million to $500,000, none of these numbers work anymore, right? So probably the most important thing is to be an active investor and watch on a weekly basis and not take the drawdowns that are inevitable, the big drawdowns. You're going to get the dips along the way and all that, but the big drawdowns, if you're in retirement, none of this works if 1 year your million went to 500,000.
Yeah, I mean, I think you could say you couldn't do this if it dropped 25% or 30%.
Right.
I mean, every little bit changes it more and more, but you know, there is, I don't think there's any reason to not actively manage your retirement account, right? I have not been able to find a reason why that's a good idea, right? Obviously, we're big supporters of it, and but for good reason. It's what you're expecting to live off of or pass on to your heirs, to someone, right? So to not actively manage your retirement account, I think is just is a bad thing to begin with. But let's just start there and say that you should be engaged. And I think this person is probably in that camp because they're asking us, right? One of the things that I want to point out, Jerry and I talked about this before the podcast, is you know there are reasons to keep your retirement account in the TSP. It all depends on your circumstances. So I don't want anyone to take away what I'm getting ready to say means, hey, you should move it out of the TSP. No, that's not. What you should do is sit down with a financial professional and figure out what works best for you. But you can leave part, you can leave all, you can take out all, you can leave all. There's lots of options and there's different reasons for that. But what I do want to point out is if you're really concerned about, performing better in your retirement account, particularly after you retire, then there is a lot to be said for rolling it over into an IRA that has, better rule sets, right? There's no 2 moves a month. There's moving it by noon, like all the things that we work against to try to help with performance, that goes away, right? And so you have a lot more options in what you can actually invest in too. A lot more options. That could be a good thing. That could be a bad thing. And you also have the option of hiring someone to help you do it. And so I think if you're really concerned about living, first of all, it goes back to what Jerry ended with. You have to accept that no matter what, you're going to have to live with what you have, not with what you want. Right? That's the biggest thing. And I think, the more realistic version of this is some years you'll have $40,000 to work with, and some years you'll have $30,000. And there may be some years you have $60,000. And the way a financial planner or financial advisor would deal with that is to help you kind of look backwards, the last 3 years, get an estimate for what you had, probably give you a buffer and say, okay, here's your cap this year. If you get to the end of the year and we've got more, then you can go back and do some other things you didn't do, purchase things you didn't do. Like that's what a financial planner does for you, is they help you look at your entire circumstances and put that into a plan that's manageable. So they are worth the money, right? Normally not if you don't have a lot of things going on in your life, but if you got $1 million in a TSP account and a pension and grown kids or kids in college, yeah, you probably do need a financial planner. Now, if you find one that can actively manage your retirement account, that's a bonus, right? They're not always the same people, right? Certain investment advisors are better at that than others. But to Jerry's point, though, flexibility, right? You're going to have to understand that over the course. So you just did, 30 years in the government, and now you're retiring. Now you think to yourself, well, I'm hopefully going to retire. I'm going to have a 30-year retirement, hopefully, right? Hopefully you last that long. So you have to treat that just the same as you did the last 30 years. There has to be a plan. You've got to carry out the plan. You've got to stay engaged and see what's going on with the market. Like, Jerry said, you don't want to take a 50% loss. That's crazy. You don't have to. And you could do that without a financial advisor, but you have to be actively engaged and well educated. But yeah, I just wanted to point out there's other options besides staying in the TSP. That's definitely something. But this is also kind of an antiquated way of looking at it, right? The 4% rule. Yep. It was based on a research that was done. I don't even remember. It was 80s or 90s, and like Jerry pointed out, the economic world was a lot different then, and so 4% kind of made it. Most advisors don't use that anymore. What they do use is sort of a fluctuating number, and it's really based on what your world looks like. You might not be able to afford 4%.
Yep. You had an interesting point that I was thinking about. This is your job in retirement. You while you're working, you're getting a paycheck every 2 weeks. You know what it's going to be. It's going to go up. You get step increases, whatever. It's going to go up. But you know what that's going to be. and you know how it's going to affect your spending and what you can do in the future and all that. When you retire, whatever you have, the combination of all your retirement assets and what those assets produce, the production is what you're living on. So you're going to get some rate of return with the combination of your pension, your Social Security, and your TSP. And the combination of all that, not the principal, but the interest that you make off of all that is your salary in retirement. And so if your principal goes down in one of those, your salary is going to go down. So your goal is to maintain that principal and hopefully grow it. And to the extent that you're willing to take risks and your circumstances allow it, you may be able to grow it more, than somebody that can't afford those risks. It's not too much different than a day job.
Yeah. I mean, hopefully it's a part-time job.
Yeah.
But it is. That's a good way to point it. I mean, I mean, that's actually how I approach it. Is this is the base salary that I get now that I'm retired. If I want to increase that, I have to go do things to increase that, right? It could be go get another job. It could be start a business. It could be, doing other investments, buying rental houses. I mean, there's tons of different ways that you can use your money in different ways than you didn't have time to do all this when you were actively employed with the military or federal government, and so all of that comes into play. And so if you want to go, sit on the porch and fish, every day or whatever, that's great. But like you still have to manage your salary, right?
Yep.
And not everybody's ready to do that at 60, because 60 seems old when you're 30. But 60 is not that old, right? You still got a lot of life left, hopefully, and want to go out and do a lot of things. And if travel is a big thing, all these things come. I mean, everybody's picture is different. That's why it's really hard to answer these questions. But it's a really great question, and I'm glad this guy. I don't know if you said his name or whatever, but yeah, I'm glad they brought it up. We love these kind of comments and these kind of questions because these are things that people are genuinely thinking about.
Yep.
And a lot of times you could get someone that's just so hard pressed. It's much like the buy and hold mentality. Let's say you ask your buddy at the coffee shop, when you're going over to Starbucks on your break, and you're both in the government, and you're like, hey, I'm thinking about this. Like, oh, I live by the 4% rule. This is what I'm going to do. And they explain it, and you kind of like, oh, I guess that's what I have to do. But you don't really understand all the nuances and what that really means. So we say this a lot, but first of all, none of this is investment advice. But really, really, if you're at this point, sit down with a fee-only financial planner and just let them help you kind of get a picture of where you're at and where you're going. If you don't want to, have them forever, you don't have to, but they can sit down with you and kind of map you out of, because your plan is different when you're 20, 30, 40.
Yep.
Then when you're 60, like we've just pointed out, now I've got my nest egg, whatever it is, it's $1 million, it's $500,000. If it's $2 million, you've got your pension, Social Security's coming, all these things. Let that get all factored in and figure out what kind of life I want to live and what kind of salary I'm going to have to live it. All right. You got anything else on this? Or?
No. The only other, I think the original of his question was, how do I do it beyond the 4% rule? And if you want to live on more than 4% and inflation is 3%, so there's 7 you have to make right there. You have to be, it comes down to your personal circumstances and risk tolerance, right? If you're willing to risk we're just talking about TSP here. If you're willing to risk your whole 100%, then be more aggressive in the stock funds. If you want to have some level of safety, then figure out what percentage you want to keep in the G fund at 4.25%, and then put the other amount at risk. But actively manage it. You can't just say, well, if I do 30% C fund or 30% G fund, 70% C fund, I'm going to make X percent more because the rate of return is 8 to 12%. Yes, it's 8 to 12% over the last 20 years. And over the last, since 2000 anyway, to 26 years, we had 2 50% drawdowns, not counting 35% in COVID and 25% in 2022.
Yeah, and some folks will say, well, we came back from that. Yes, we did. But if you're retired and your principal went down by half, 4% of that is way different than 4% of where you started. Right. So it's, I don't think there's any reason to take that kind of loss. But you definitely can't take it when you're retired, right? A lot of people say, well, if you're in your 20s and 30s, you can recover from it. That is true. You probably can, but I don't know why you would want to. I certainly wouldn't want to lose 50% of anything. But one of the last things I wanted to point out, because, we use the term, based on your personal circumstances and risk tolerance, but I want to add one more for this one particularly. It 100% your personal circumstances, what's going on in your life, what your risk tolerance is, but what's your education level, your financial education level, right? If you're taking all of our courses and you're out there watching, other advisors and educating yourself to be a good investor, an educated investor, not just a good investor, an educated investor, this will work. You can do this. You absolutely can, because you're going to know where your risk points are. You're going to know where your lines in the sand. You're going to be like, nope, we're going to, if let's say you stay in a TSP, there may be some time periods where you'll go 70-30, 70% C, 30% G. But let's say you need to pull out more to get to your 4%, then you may need to shift that, right? You don't really pull from the G fund. Like, you can't take your withdrawals just from that. Right. But that would mean if you pulled enough, you'd need to rebalance that so that you did have it right. So, but you could easily do all that if you educate yourself on how to do it. And we're not the only ones that do it, but we do it a lot. So hope you guys got something out of that. I think that's a really good topic.
Awesome. Yeah, keep sending those questions. This was a good one. All right, so a little bit on market structure. I put up a similar chart to this last week. This is the S&P 500. So it's a weekly chart. So each one of these red and green ticks is 1 week of price movement. And we went back to the bottom here in COVID. And so we talk a lot about Fibonacci extensions and retracements, and there are all kinds of technical ways to create to create targets for price. But another way to look at it is just to look at the structure. So if we're just looking at the price of the S&P 500 since the bottom in COVID, this was the low. Then in 2022, it came down to here. And all I did was connect the lows. And they all connect, right? So that's a really good bottom trend line. And then I made this parallel and put in this line up here and just pulled it up to the top in January 2022 and extended that line out. And so now we've been riding that trend line for a while, right? So the structure, not using any targets or anything else, the structure, which is now 6 years old, would indicate that the market is likely to come back down, right? At least on the last 3 cycles, when it comes back down, it comes down to the prior high, right? So if it came down to the prior high this time, it would get to that midline. So we would expect a lot of support at that point. We could get something like this, and it breaks through and goes down to the lower trend line. But those are places where you're looking to either get in, right? If you're up here and you're in the G fund because you're like, all right, I'm at the top of the structure. It makes sense to see. It could, we could get a blow off top. We get a weekly close up here. The market keeps going. Now we're outside of the structure. But as long as we're in the structure, it makes sense to respect it. It doesn't tell us which way the market's going. It's just giving us, it's a roadmap is really what it is. And if we take a sharp turn to the left and go up here, great, the structure changes. But it is the structure until it changes, right? So that's kind of one way of that's the big picture of the structure. If we kind of drill it down to where we are right now, this was the October peak of last year. We have gone nowhere since October. We're in this range-bound, sideways market, however you want to look at it. And this November low is really the big one, right? If we get down here below that November low, it's very likely we're going to potentially come back down and test the April 2025 bottom somewhere, right? That's what's in the scope if we do that. But in the short term, if you're just looking at it, 6,800, right? That's been a pretty good bottom for quite a while. And if we got above 7,000, right, then things are different. If we're up here, we're most likely going up. If we're down here, we're most likely going down. So as long as we're still in this sideways channel, you either ride it out or you look at it and say, on a week like this, we are right at the midpoint. We're in the middle of that channel right now. It also looks like we're in a rolling topping pattern. You might look at that and say, I'm going to go to the G fund. If we get above 7,000, I'll get back into the C fund. Right? You might say, I'm going to ride it out until we get down here to make sure we're below 6,800. Maybe I'm going to wait till we get to 6,700 before I get out, because my personal circumstances and risk tolerance, my risk tolerance allows me to do that. Right now, we are right in the middle of that range. Okay, so midterm elections. This one I thought was pretty interesting. We put up this chart quite a bit, and I'm sure we're going to continue because this is really the expected roadmap for 2026. Right? It takes a whole bunch of things into account on this composite cycle for 2026. Ned Davis research is really, really good. It's a composite of a whole bunch of different cycles, and what it's basically telling you, we're not here anymore. This is kind of an old chart, so middle of February, let's say, is right here, right? We've been in this churn that's likely to continue into March. Let's say it does. It resolves to the upside. We get to the middle of April, and that's around the time period where we should expect our first significant decline of the year. Okay. We get a rally into the summer, and then another rollover. But what's interesting is October is the bottom for the year. It's a midterm election year, and the cycle is calling for a big move higher into 2027. So that's kind of where we are, and the expectation of the roadmap here when the midterm elections happen. So this is a really good tweet, or X, or whatever they call it now, at Seth CL. So 100% of the time, okay, since 1942, buying the S&P 500 on midterm election day generated a median return of 15.2%. That's huge, right? The following 7 months. So over the following 7 months, the average return has been 15.2%, going back to 1942. And it has never, not once, had a negative return 7 months forward. Doesn't mean this year can't be different, but that's what it looks like, right? This is from the most recent midterm election. Obviously, we've had Republicans and Democrats in the White House all the way back to 1940, whatever it said. And there have been some really big gains 7 months forward from the midterm election. To get there, you generally have some big drawdown before it. That's what generates the energy for this to happen. So you can't look at it in a silo. It doesn't, if the market's going up and then we have midterm elections, it doesn't just keep screaming up for no reason. You got to have some kind of pullback to generate the momentum, to the kind of the power behind that move. That's how you get moves like this. You know, a 20% move over 7 months is coming off a low, right? It's not coming off an all-time high. So ideally, we get some kind of really decent pullback going into the midterm election. And then the cycle and the history would suggest you pile in at that point and you're good for some amount of time. Yeah. All right. So the current TSP fund direction, there's not a whole lot to say about it, right? This is the S&P 500 on a weekly basis. At the close of each week, you have a closing price and you connect the prior week with a line, and that's how you get a line chart. You get the 20-week moving average line, relative strength, and MACD momentum indicator. So as long as the black line is above the blue line, you're good. right? And when the blue line is trending up, that's the black line kind of wiggles, right? The blue line smooths it all out. It's a 20-week moving average line. So as long as the slope of the blue line is up, the average, the 20-week moving average line is up. So the trend is up. Last week we had a bit of a downtick. This week it's turning back up. As long as we stay above that blue line, the trend is up. Relative strength is starting to roll over. It's been rolling over for a while. MACD is not looking good. I mean, there's definitely some weakness in the market. That doesn't mean it can't turn back around. And at the end of the day, price is the only thing that matters. So as long as we are above that rising 20-week moving average line, the trend is up. And then bonds. So the F fund, we did the same thing with the F fund. F fund has basically been sideways since the middle of 2022, right? And then most recently, we had this 10-week flat period right here. Last week, we had a big uptick, and it couldn't push above 102. Well, even less than that, like 101.75 there. And it's coming back down. So whether or not, the F fund continues down, in the big scheme of things, if the F fund goes up, it means interest rates are going down. If interest rates are going down because the economy is really strong, the new Fed chairman comes in and lowers rates, and the bond market plays along, rates come down, the F fund goes up, that would be great. If the stock market starts to fall, or unemployment starts going up a lot, and the Fed lowers rates, the F fund also goes up. But then the stock funds are probably going down. And that's when we're using the F fund as a tool, right? If the F fund goes down, it means interest rates are going up. That's not good for stocks, right? Not in this environment. So those are the options. I still think that the F fund is going to be the most important fund to watch, which will tell us which way stocks are going in the future. Right? Questions?
All right. A lot of things to watch and a lot of things to keep our eyes on. I guess that's the same thing. A lot of things going on and a lot of things to watch. That's what I was thinking in my brain. Yeah, I mean, the world's chaos right now. Thankfully, the market's not, right? We don't know what's going on with it. We just we go with what we have. And right now, things look pretty good.
Yep.
So don't put your head in the sand. Keep your eyes on everything and watch the show every week. If you like what you hear on the show, please share it with your friends. If you watch this on YouTube, please hit the big subscribe button. That helps us out. If you have any questions or comments, please put them in the comment section wherever you find the video. If there is no comment section, you can always email us at support@growmytsp.com. Hope you guys are doing well, and we will see you next week.